Hello everyone, my name is Simo and welcome back to Investment Research. Today we are going to take a deep and realistic look at one of the most talked about fintech stocks in the market today, SoFi Technologies. There has been a lot of noise surrounding this company, from optimistic investors who see it as the future of digital banking to skeptics who think it is overvalued and heading for a correction. My goal today is to look at the facts, separate emotion from analysis, and give you a clear picture of where SoFi stands in October 2025, what is driving its momentum, and what challenges could shape its next move as we head toward 2026. SoFi has experienced a remarkable run this year. The stock recently jumped about 8% in a single day and is now trading around $28.76 per share. Year to date, SoFi is up roughly 70%, far outperforming both the S&P 500 and most traditional financial stocks. If we look over the last 12 months, the stock has risen by around 230%. That performance has pushed SoFi into the spotlight, making it one of the strongest performing names in the fintech sector in 2025. But that kind of momentum always brings a test. And for SoFi, the next big test will come with its upcoming third quarter earnings report on October 28th. This event will likely determine whether SoFi's fundamentals truly justify the optimism or if investors have been pricing in perfection. Analysts are expecting revenue of about $880 million, representing 28% growth compared to last year. Earnings per share are forecast to come in at around 8 cents, a 60% increase year over year. In the previous quarter, SoFi reported 8 cents per share in earnings, beating estimates of 6 cents and delivering a 44% increase in revenue from the prior year. That strong result prompted management to raise its full-year revenue guidance to approximately $3.37 billion. Perhaps even more important is the fact that SoFi has now achieved 7 consecutive quarters of GAAP profitability. This is a major milestone in fintech because many competitors, such as Affirm and Robinhood, are still posting losses. Profitability gives SoFi the ability to reinvest in growth, scale its operations, and build long-term shareholder value without relying on external capital. At the heart of SoFi's strategy is what it calls the financial super app. The company's goal is simple but ambitious, to bring together all major financial services under one digital roof. SoFi wants to be the go-to platform where users handle everything from loans and savings to investing and insurance. This ecosystem approach increases engagement and customer loyalty. Once a customer opens a high-yield savings account or takes a personal loan, SoFi can cross-sell other products like credit cards, brokerage accounts, or insurance. Over time, this model raises the lifetime value of each member. Recent results show the strategy is working. SoFi added about 850,000 new members in the second quarter, bringing its total membership to 11.7 million. Those members are now using more than 17 million different products across the platform, showing the depth of engagement the company is building. The financial services division, which includes checking, savings, and investing products, saw revenue climb 106% year over year, while contribution profit surged 241% to $188 million. That nearly matches the lending division's total profit, showing that SoFi is becoming much more than just a loan provider. Another key driver of growth is SoFi's technology infrastructure arm, Galileo. Galileo recently joined the Amazon Web Services Partner Network, which gives it global exposure to fintech startups and financial institutions that use AWS to power their operations. This partnership expands SoFi's reach and positions Galileo as a major B2B platform in the digital payments and banking space. Innovation continues to be a major theme for SoFi. The company recently introduced commission-free options trading to attract younger and more active investors. It also launched an AI-focused exchange-traded fund called AGIQ to capture investor interest in artificial intelligence. SoFi is also exploring new payment technologies, including blockchain solutions for faster international transfers through the Bitcoin Lightning Network. There is even discussion of developing an FDIC-insured stablecoin, which could put SoFi at the forefront of the next evolution of digital finance. Now, let's look at how Wall Street views the company. Opinions are split. The consensus rating for SoFi is currently a hold, but behind that label is a major divide between bullish and bearish analysts. On the bullish side, firms like Mizuho, Needham, and William Blair see SoFi's growth trajectory as sustainable. They highlight the company's strong fundamentals, its ability to innovate, and its advantage of having a national bank charter. This allows SoFi to fund loans with customer deposits at lower costs compared to fintech rivals that rely on external lenders. These analysts also point to potential macroeconomic tailwinds. Many expect the Federal Reserve to begin cutting interest rates in 2025, which could reignite loan demand and refinancing activity. That could provide a significant lift to SoFi's core lending business. Some analysts even believe SoFi can grow into its current valuation, as earnings per share could reach between 55 and 80 cents by 2026. However, the bearish analysts remain skeptical. They warn that SoFi's valuation has already priced in too much optimism. At the moment, the stock trades at nearly 50 times forward earnings and over 9 times sales, far higher than most fintech peers. For comparison, Block trades around 21 times forward earnings and Lending Club around 23. Bears argue that such a high valuation leaves very little room for error. Any slowdown in growth, margin compression, or missed earnings could trigger a sharp pullback. They also caution that falling interest rates, while positive for loan growth, could reduce net interest margins, meaning SoFi earns less profit per loan. Some firms, such as Morgan Stanley, have called the recent rally overextended and suggested that the stock may struggle to attract new buyers at these prices. The consensus price target across analysts is about $20.57, which implies roughly 28% downside from current levels. In my view, SoFi is at a turning point. It has achieved consistent growth, profitability, and brand recognition, which are not easy accomplishments in fintech. However, it also faces the challenge of maintaining this pace without slipping. Investors should focus on whether SoFi can keep expanding its membership, improving margins, and managing risk in a changing rate environment. The opportunities ahead are significant. If the US government moves toward privatizing its $1.6 trillion student loan portfolio, SoFi could capture a meaningful portion of that market. Lower interest rates could also stimulate personal and home loan demand, and SoFi's diversified platform positions it to benefit across multiple categories. The risk side of the story includes execution pressure, competition from both traditional banks and new fintech entrants, and regulatory changes that could affect its crypto or banking initiatives. Overall, SoFi represents both opportunity and caution. It's a rare example of a fintech that has managed to balance innovation with real profitability, but its valuation demands near-perfect execution. For long-term investors who believe in the continued shift toward digital finance, SoFi could still be an attractive play, provided they are ready for volatility. For others, it might be wiser to wait for a more favorable entry point closer to its fair value. That wraps up today's analysis. I am Simo from Investment Research. If you found this breakdown helpful, please subscribe, share your honest opinion in the comments, and let me know if you think SoFi will keep growing in 2026 or if it's due for a pullback. Thank you for watching and see you in the next video.